Thank you, Leon. And good morning, everyone. Leon threw out the challenge before to the banking sector that to get our mind around development finance for new precincts in particular, what could have been but for lack of funding. What, in particular for new precinct funding, where we're talking about placemaking, is what could have been but for better structuring and understanding. In terms of financing new precinct developments, what film line would a banker be more apt to say? Build it and they will come, build their dreams, or tell them they're dreaming, the castle. So, can we approach placemaking and precinct funding in a systematic way that gives confidence to cautious bankers? We are a cynical bunch and we sometimes pretty cold measured about what we look at, but there are some key concepts which I want to bring out in terms of what we can perhaps embrace. Financiers expect sustainable and preferably increasing values with the assets that we finance. We look for risks that could particularly undermine values. Does the planned precinct have a favourable mix of office, retail, entertainment, residential and open space? All at a required quality level, otherwise it will deter further similar quality developments, and also that aspect of retaining tenants that do come in the first place and attract tenants to come into new stock and replace ones that leave. Similarly, the prospect of unplanned excessive supply of any one sector will dampen values and demand, so strict staging is important in that there's supply meets demand and no more than that, and also avoids barren strips between building islands, particularly when you're looking at a large precinct, because that can depress values. So these profiles go some of the way to helping placemaking to help ensure buildings deliver the quality of development needed to underpin those values. As people eat, sleep, play and work in a precinct, how does that impact values? One possibility is that as the community of workers and residents and people visiting grow, it creates primary and secondary demand in that precinct. So from the outset, the master developer in a precinct can systematically model how those volumes are to grow over the planned horizon and show how the infrastructure is also going to match over time: transport, childcare, access to schooling, etc., that supports such growth. Even though they're subjective, they go a long way in terms of showing how and why this will happen. That will even help persuade bankers, particularly where it's placed in valuation reports. So we throw out a challenge, open question to the valuers in terms of our dialogue as to how that can be brought into their reports to again underpin sustainability of values on the commentary in their reports. How both banks approach development lending. Banks do not take equity risk, or don't plan to in any event. Assessments and structuring are to minimise risk for our capped credit margin. Some key assessments are: does it have strong certainty of being completed? The experience of the developer in getting the design and costings right, and they've completed similar buildings along that line. What is our takeout? Either someone is contracted to buy completion, or there is sufficient pre-committed tenancy to cover interest servicing on a term debt basis. But particularly, are values sustainable? Insufficiently restrained supply or inadequate planning mix is very difficult to recover from, especially if the market builds or occupies in an ad hoc manner with low quality pockets. You can think of various strips around Melbourne. You even think of Swanston Street strip in the CBD as to, once it's entrenched, how difficult it is to recover from that point. So financiers do look to master developers in the precinct to have a disciplined process, so the existing new stock value is not going to be diluted by excessive supply coming on, or low value or uncomplementary developments coming into the precinct. There is an element of contagious confidence with substance. what a government planning agency such as Vic Urban can bring to the table is confidence a planned stage precinct will happen. We are presently involved in financing a new tower in the Dandenong rejuvenation strategy. Our experience has been one where engagement is not to be underestimated. We do our normal due diligence, we engage with our developer and borrower, but what has been an interesting journey has been engagement with Vic Urban and understanding the precinct, going out there, talking it through, understanding their role, and grabbing the takeaways in this particular precinct of the state government policy that is there, of how and why they're rejuvenating Dandenong, why government and commercial tenants want to go there. It is a 15 to 20 year strategic plan, and there is expected a $1 billion build-out value. Some facts that sort of grabbed our attention. And such a structured plan for a large vision enabled our sometimes cynical analysis to move past our sometimes dismissive reactions to high quality developments in a low value area. It gave us confidence in some subjective ways that the developments will happen in such a precinct, and as financiers we should be on board to gain direct experience from the outset and to be involved in the pipeline of future developments. The planned basis especially gave cause to understand quality and restricted staged supply that should influence market rents in the precinct to rise, as will values over time. Nevertheless, as financiers, where the new rents are above current prevailing neighbourhood market rents, there will be a risk that if tenants were to leave, they might drop back. So finance structuring mechanisms will generally require in new precincts that we maximise the loan value at the outset, but generally we'll look to some mechanisms such as amortisation of the loan with the rents that are coming in, just to build in an extra buffer over time. But as soon as possible, that might be 2 to 3 years or thereafter, the loans can be restructured and the pricing reviewed so that that can be flattened out again and the developer gets some of his equity back. But in the first place, the financing is there to make it happen, but the equity risk, and I need to make that distinction between who bears that risk, the equity risk and the upside is by the developer. So that's why, in terms of the partnership between the bank and the developer, the lease income at that point will, for a while, need to be directed towards or partially directed to loan reductions, but in itself will still preserve or increase equity at that point. There is a challenge to the finance sector to be engaged in, to be educated and engaged in with these master precincts. It's all very good, all normal for a bank sometimes to make just the paperwork decisions, sometimes be in the ivory tower, but to get out there and engage with the advisors, with the planning agencies, with the developers, that transparency and engagement is vital, and I think that sometimes it's not there. So perhaps the challenge is to the banks and the developers and everyone involved in the whole process, including Vic Urban, is to make sure it's structured well, and then the banks will come. Thanks, Leon.